Types of Life Insurance Primer with Mitchell Nelson, Monmouth Financial Services. I am Mitchell Nelson, the founder and president of Monmouth Financial Services. For almost 2 decades, I have worked with individuals and small businesses like you who are constantly striving to put their families in a sound financial situation. I endeavor to know and understand your financial situation and goals and provide you only the highest quality information, services, and products to help you reach your goals. The reasons for life insurance. 1. Replace income for dependents. If people depend on an individual's income, life insurance can replace that income if the person dies. The most common example of this is parents with young children. Insurance to replace income can be especially useful if the government or employer-sponsored benefits of the surviving spouse or domestic partner will be reduced after the companion dies. 2. Pay final expenses. Life insurance can pay funeral and burial costs, probate and other estate administration costs, debts, and medical expenses not covered by health insurance. 3. Create an inheritance for heirs. Even though there are no other assets to pass on, life insurance can create an inheritance by buying a life insurance policy and naming their heirs as beneficiaries. 4. Pay federal death taxes and state death taxes. Life insurance benefits can pay for the estate taxes so that heirs will not have to liquidate other assets or take a smaller inheritance. 5. Make significant charitable contributions. By making a charity the beneficiary of their life insurance policies, individuals can make a much larger contribution than if they donated the cash equivalent of the policy's premiums. 6. Create a source of savings. Some types of life insurance create a cash value that, if not paid out as a death benefit, can be borrowed or withdrawn on the owner's request. Since most people make paying their life insurance policy premiums a high priority, buying a cash value type policy can create a kind of forced savings plan. Furthermore, the interest credited is tax deferred and tax exempt if the money is paid out as a death claim. There are 2 major types of life insurance, term and whole life. Term insurance is the simplest form of life insurance. It pays only if the death occurs during the term of the policy, which is usually 1 to 30 years. Most term policies have no other benefit provisions. There are 2 basic types of term life insurance policies, level term and decreasing term. Level term means the death benefit stays the same throughout the duration of the policy. Decreasing term means that the death benefit drops usually in 1-year increments over the course of the policy's term. Whole life or permanent insurance pays a death benefit whenever the policyholder dies. There are 3 major types of whole life or permanent life insurance: traditional whole life, universal life, and variable universal life, and there are variations within each type. In the case of traditional whole life, both the death benefit and the premium are designed to stay the same, in other words, level, throughout the life of the policy. The cost per $1,000 of benefit increases as the insured person ages, and it obviously gets very high when the insured lives to 80 and beyond. The insurance company keeps the premium level by charging a premium that, in early years, is higher than what is needed to pay claims, investing that money, and then using it to supplement the level premium to help pay the cost of life insurance for older people. By law, when these overpayments reach a certain amount, they must be available to the policyholder as a cash value if he or she decides not to continue with the original plan. The cash value is an alternative, but not an additional benefit under the policy. Universal life, also known as adjustable life, allows more flexibility than traditional life policy. The savings vehicle, called a cash value account, generally earns money market rate of interest. After money has accumulated in the account, the policyholder will also have the option of altering premium payments, providing there is enough money in the account to cover costs. Variable life policies combine death protection with a savings account that can be invested in stocks, bonds, and money market mutual funds. The value of the policy may grow more quickly but involves more risk. If investments do not perform well, the cash value and death benefit may decrease. Some policies, however, guarantee that the death benefit will not fall below a minimal level. Another variant, universal variable life, combines the feature of variable and universal life policies. It has investment risks and rewards characteristic of variable life insurance, coupled with the ability to adjust premiums and death benefits that is characteristic of universal life insurance. I founded Monmouth Financial Services to provide my clients with professional, friendly advice so they can achieve their personal financial goals. I have successfully helped many people and business owners, and I'll be delighted to offer you a consultation on you and your employees' financial goals. You could find out more about me and our services at www.monmouthfs.com, or you can call 732-660-1798 or 908-463-3668, or email me to set up a time to talk. Thank you for watching this video. Securities offered through S.A. Stone Wealth Management, Inc., member of FINRA SIPC. Advisory services offered through S.A. Stone Investment Advisors, Inc., an SEC-registered investment advisor. You can reach me at 732-660-1798 or 908-463-3668, or email me at mitchell.nelson@saswealth.com.